Jim Bianco, founder and president of Bianco Research, joining me now with more. Jim, it finally happened. That 1% ceiling has been cracked, but the velocity of the move is pretty remarkable. We are 20 basis points higher on this Friday than we were on Monday. Do you think it's gotten a little too far ahead of itself? What are you expecting in the near to medium term in terms of trajectory?
Well, in the near to medium term, I do think that you'll probably see some kind of a peak and a pullback. But beyond that, I do think that the trend will continue higher. And feeding off of the comments that were made coming into this, rising rates in and of themselves are neither good or bad. It depends on why they're rising. If they're rising because real growth is expanding or reflation, that's actually an okay thing. But if they're rising because inflation is expanding, that is actually going to be problematic, I think, for risk markets like the stock market and for the bond market as we move forward. So the real question is, as that trend reasserts itself higher, is it going to be reflation or is it going to be inflation?
But talking about why they're rising, Jim, it's all on expectation at this point. The expectation of more stimulus coming out of a democratically controlled government at some point in the coming months. What does that number need to be then to justify where yields are right now and the expectation, as you say, that they are going to inch higher?
I think that the yields are probably justified given the expectations of probably $400 billion plus that's going to come with a $2,000 check, with an infrastructure bill that's coming after that, and probably more stimulus further down the road. Remember, more stimulus means more supply. It means a higher chance of inflation because you're stimulating demand. You're handing people money, telling them to go buy things, and you can bid up the prices of them as well, too. So I don't think the market's out of line with what it's been doing by going through 1%. I guess really the real question is, which way do we think it's going to ultimately go? I know most people think it's going to be a reflation trade, and I'm actually kind of worried that it might be an inflation trade as the rest of 2021 unfolds.
What do you think the Fed thinks, and what are the implications of that? If we do see a material move higher in yields, and that implies some kind of tightening of financial conditions, do you expect them to tolerate that? Because that would kind of run counter to their goals here.
No, they'll tolerate it and they'll celebrate it. Charlie Evans, the Chicago Fed president, basically said earlier this week that they're expecting core inflation to go to 2.5%, which I might add would be about a 28-year high. It's been that long since we've been that high on core inflation. He also said we're in it to win it as far as getting higher inflation, and they'll embrace it. Now, the real issue is it's not up to the Fed, it's up to the market. Remember the fourth quarter of 2018 when they started to reduce the balance sheet. They said it would be on automatic pilot and watch the paint dry. And the market didn't like that and sold off sharply. And within 2 weeks, the Fed abandoned that policy. So they could say 2.5% or whatever, and that this is what they want. But if we get to a rate level or an environment where the market doesn't like it and reacts badly, then we could probably see the Fed buckle and change their policy just as quickly as we did in 2018.
Okay, well, talking about inflation and expectations for it, when it comes to break-evens, 10-year rate above 2%, as is the 5-year forward. Standard Charter, Steve England over there, as well as other strategists say that's not so much about actual inflation expectations. That is higher oil prices and a disintegrating dollar. Do you agree with that view?
Well, it's kind of hard to separate the two. I mean, they're technically correct, especially if you look at the TIPS break-even curve. The 2-year break-even is higher than the 10-year break-even. And that's typically the case when you get higher oil and you get some kind of other technical factor like that, that's going to push it higher. But ultimately, I think that in the big picture, these are pointing towards more inflation as we move forward from here.
Well, let's go back to the Fed, which you were talking about earlier. I feel like the minutes from the December meeting really got put on the back burner this week, given everything that was going on. Was there anything in those minutes that maybe led you to kind of change your calculus, the way you think the Fed is thinking about things at this point in time?
Not really. There was no surprise in there other than that the Fed is holding back on another set of tools like yield curve control or extending the maturities that they're purchasing in an event that rates go up and that they feel like there's going to be a need for them to start to suppress rates as they go down. And I'll come back, being a broken record in this interview, if rates are going up because of inflation and they try and suppress them, I fear it will end badly. If rates are going up because of reflation or real growth expanding and they try and suppress them, I think the market would be okay with that. really comes down to why they're moving higher. And right now, everybody, again, thinks it's reflation, but I fear that that will give way to deflation later this year, or inflation later this year.
If it is reflation and if we see this yields moving higher story, at what point, at what threshold does that begin to affect equities? Right now, the earnings yield on the S&P 500 versus the yield on the 10-year, is that gap between the two is the narrowest in about 2 years. When does that start to matter?
You know, it's hard to put a level on it because also the speed that it moves matters too. So like this week, 110 on the 10-year yield is as important as the 20 basis point move that we've had. But I think if we were to see rates move above 1.25 towards 1.5, say in the next couple of months, that would be a point where everybody would really start to question what's going on with the market. It would be about as much about the speed as it is about the level. We got to that level in the second half of the year. I don't think it would be nearly as impactful as if we did it sooner.
All right. In the meantime, we wait and we watch. Jim Bianco, thank you so much for joining us.